Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle, and Happy New Year.
Happy New Year to you and to all the listeners.
Danielle, is there an elevated risk exposure for people still in the stock markets?
Well, yes, for a number of reasons. One, because this particular upcycle has been so extreme and rapid since the pandemic hit in 2020 and the market sold off, that people really have gone all in. So they've thought that this kind of a quick, rapid recovery was sustainable or, typical, or that we've launched in some new expansion cycle in terms of the stock market. And so they've really taken any cash that they had at all and funneled it in, and not to mention borrowed a lot more to buy assets or to borrow against their portfolios. So as prices go up, of course, that it increases equity available, and people have been withdrawing it for spending, for, as I said, for other investment purposes, kind of like what they do with home equity lines of credit. Same thing. As the price goes up, people tap the equity by withdrawing it through various forms of indebtedness. And that means that they have very little cash buffer, if any at all. They tend to have, and we see that right now in the stats. So the amount of cash that people have that is not in housing or other securities markets is at a cycle low, something we haven't seen since the 2007 cycle top, when stocks were also very high and everyone had thrown every last nickel into the asset bubble that was then brewing. The same thing is happening today. So we have portfolio managers globally that have less than 2% cash, and we have individuals overall with 40% of their net equity, including, your home equity and whatever savings you have, 40% of that is presently in the stock market, compared to a long-term average of about 18%, because traditionally people had, the most of their equity in their home, and they didn't have a lot of participation in things like stocks. But again, this has been such a miraculous bubble that has attracted so many people in the last couple of years in particular, that now we have this massive overweight on the household balance sheet to these risky assets. And like I say, the very little cash means that whenever anything goes wrong with one's income or revenue, whether it's a business or a person working as an employee, whenever anything hits on the income side such that they have a decrease, they typically need to access cash to bump up their household, funds in order to sustain their lifestyle. And so that's when they look to withdraw cash from other things. Now, if they go into this downturn with, as I say, already having tapped the bulk of the equity in the home, or with high consumer debt or high business loans, and have already, as I said, borrowed a lot against the asset portfolios and the stocks and things, what happens is that as prices start to go down, they don't have any access to additional capital. At the same time, the banks typically do things like pull in lines of credit. So a lot of business owners, for example, will go into late in a cycle, will get complacent about whether they have much cash on hand, and they will have a lot of debt, and they will not, and households do this too, and they won't think about whether they have much savings, and they'll say, well, I have a line of credit. But as we saw in 2008, when the banks get into a strife position and a lot of people start having defaults, they typically will do things like cancel lines of credit. So all of a sudden, the lifeline that people thought they had is no longer there. And what ends up happening is it drives a selling wave. A liquidation cycle is what they're known as, where people have to start selling everything. Whether they like something or not, they'll basically sell whatever it is that that there's a market for, that they can get in order to swap in and raise their cash. So that's the kind of thing that we do backwards every cycle, it seems. Rather than build up the cash during the bubble phase when everybody is buying price indiscriminately and not managing their risk appropriately, if you could build up your cash during that phase, which is essentially the management style that we have taken over the last 20 years, then ultimately you do have the liquidity to buy off of everyone else when they're liquidating. And it's very important this cycle more than ever because the concentration risk that we see in things for, year to date so far, the stock market is selling off, as you know, because the central bank in the U.S. intimated that they will start not only stop their bond buying by March of this year, but in the minutes yesterday it indicated they also think they're going to start shrinking their $8.6 trillion holding of securities that they have on the central bank balance sheet, and selling those or not renewing as treasuries come due, not rolling the funds back over. So ultimately what this means is that there's going to be less liquidity. There's already less liquidity in financial markets because central banks have been walking back their QE policies during 2021. They plan to accelerate that in 2022. And so the economy was already having a lot of strife because of the problems with the ongoing problems with the pandemic and the renewed shutdown. Small business stress is very high. But you layer on to that this, as I say, very high level of debt and very low level of cash in the system, and you have people that are very stressed out before we even get to more asset declines. So, and the asset declines, as I've described in the past, why I talk about leverage so much is because from these high levels of indebtedness and leverage, what you get is very abrupt moves in asset markets. So you see very steep drops typically. And, it's hard to explain the level of obscenity, which is the norm these days. But just the S&P 500, which so far is very barely, the Dow and the S&P are very barely off their all-time highs at this point. But underneath the surface, you see that the average component in the index of the S&P, for example, is negative 11% from its 52-week high already, and that was before we got into this week of renewed selling. Only the five largest, Microsoft, Nvidia, Google, and Tesla, essentially those have made up 50% of the gains that we've seen in the S&P since April. And the top 10 stocks now, and that includes Apple in that basket, are 30% of the entire market. Well, we've never seen such concentration. That's way more concentrated than even the tech bubble top of 2000. We haven't seen that level of concentration since the Nifty 50 craze, which was prevalent in the peak of the 1969 cycle. The stock market topped out in 69 and entered a 17-year secular bear market, which is typical following these very high valuation phases, where it then trades, from having a drop and then a recovery to a lesser high and another drop, and it goes on for 17 years. And I think that's really what we've set ourselves up for again here. So all the people that thought that you couldn't lose money in stocks in the last year are going to learn that that was a very anomalous environment. And indeed, we're seeing that already year to date. There's been a ton of carnage in individual names, in some of the things that were very hot in the past year. And I can talk further about that if in another segment.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. So apart from these five super mega stocks that are holding up the market, propping up the roof, I guess they're the five pillars holding the roof up. What happens when we start looking in the living room, the bedroom, the kitchen of the market?
Yeah, and the thing is, I think people think that because that the market has become so dependent on these five sort of generals, so to speak, and we have it in the Canadian market, of course, with, we had Shopify being an all-star. Well, it's off about 30% now since November 14th. So this is what I'm talking about. You get very high valuations, over exuberance, paying regardless of any kind of mathematical likelihood of return, and all of a sudden things start to reverse very quickly. Still, we have the financials holding up the Canadian market, and energy is holding up so far. Just in the last couple of months, oil prices have been rising again. Ironically, a lot to do with the very cold temperatures in the Midwest and some of the disruptions in the pipelines and issues that are happening there has spiked oil prices, even as global demand is being ratcheted down because we're back in this very significant lockdown, certainly in many parts of the world thanks to the pandemic. So we've got this, the fiscal impulse is contracting going into 2022. In other words, government spending can't continue to replicate the trillions that it has over the last 2 years. At the same time, you've got this extraction of excess liquidity by central banks, and you've got a cash crunch that's been going on for some time. So if you look at under that, the broader economy is more reflected in something like the Russell 2000, which is the mid-cap stocks, for example, and it's a broader base than something like the largest 500. And that index is actually already off 10% from November and back where it was last January. So essentially, it's accomplished nothing in the last year, and that's really reflective of what's truly going on in the economy, if you think about it. Whereas, a lot of this, as I say, the flashy stocks have really had all the attention, but they're also breaking down at a rapid pace, where you've got, things like Robinhood, this crazy IPO that came out in August with all the retail traders borrowing money on margin and buying options and, trading daily, and this was their sort of main activity over for a good part of the 2021, and now that share is off 60% already from where it peaked, and it's below its IPO price. So, actually in 2021, there was so many of these initial public offerings. There was something like 3 times the normal issuance because the retail appetite was so high. So companies, and this is how companies make money, they think, great, everybody's buying stock, the good, the bad, and the ugly at this point, so let's just sell our own shares into the public market and take the cash out. And so they've been using that to funnel their, insiders have been selling, billionaires have been selling into this retail flow, which has been off the charts. Unprecedented amount of people funneling into passive products like funds and fund and index tracking portfolios, ETFs, this sort of thing. So all the capital, that's retail, funneling in, putting every last nickel of savings they can scrape up into these highly volatile assets. And, following stories. So these, Peloton was this huge popular stock, of course, while everyone went inside, and they're back inside, frankly, on their bikes. But the Peloton shares are down about 79% from where they peaked in December of last year. GameStop and AMC, these things are off about 70%. The SPAC IPO, this is this crazy basket of special purpose vehicles where, people say, I don't know what we're going to invest in, but everyone's dying to give us money right now, so let's just bring in cash and we'll say we'll buy stuff later. And they actually have been IPOing these SPACs at as I say, about 3 times the average issuance globally, and 2/3 of the ones that came out in 2021 are already negative. So it's been a boondoggle of extraordinary measures. Unlike anything we've seen actually since at least the tech top in 2000, which I remember very well, where people have just been indiscriminate. And it's not just individuals, it's the so-called professional managers as well, because, they've all underperformed for a large part this index, which everyone's chasing, this, as I say, the S&P 5, which everyone has they're benchmarked against. So if they're not doing as well as that concentrated little basket of shares, they feel like they have to take more risks to try and justify their existence, to try and justify the fee they're charging, which is all this, as I say, race to the bottom. So now I think people are in for some more wake-up call, just reality's dawning that things like the cryptocurrencies have been tanking as well. Bitcoin's off about 36% so far from where it was in November. So you get my point about how rapid this is happening just in the last 2 months. And I always go back to March of 20, where, people forget, but in 15 trading days, the TSX itself lost 37%. The broad markets fell that much in 15 trading days. That's this hyper speed thing I'm talking about with all the leverage and indebtedness and people borrowing on borrowing on borrowing and then having to quickly liquidate to cover their margin calls and the cash needs that they have. And so that's the kind of thing we're set up for, where those that looked like genius a couple of months ago are going to be taken to the woodshed here. I mean, just ARC Innovation, that one fund, which is, run by Cathie Wood out of the U.S., it's off 44%, since its peak in February when everybody thought that she was the second coming of you-know-what. So anyway, it's really just those who've been riding the volatility up and magnifying it with leverage have looked genius, and now they're quickly being revealed as, doing nothing other than taking reckless risk.
Friend of the show, Tim Cyclesman Wood, says he just follows Dow theory, but he said cracks are showing in the foundation.
Oh, well, yes, exactly. The breadth is terrible. That's the word for it when there's only a few stocks that are actually holding the thing up. And again, people think they're infallible. We've seen this so many times. As I mentioned in the late 60s cycle, the Nifty 50 were, the Kodaks of the world and the General Electrics and the Westinghouse and all these brand names that people thought were, the best brands in the world, and that they then extrapolate that into thinking that they'll always be the best brands, and or that the shares are a great thing you can buy at any price. Which is the exact opposite thought. It's the wrong thought, because what happens is once everyone has already bought in and paid up for the next, 20 years of potential earnings, like for example, the S&P 500, the average CAPE or price smooth Shiller PE for that is about 40 times today. That's 3 standard deviations above the long-term norm, which is, by the way, 17. So we're more than 2 times that. And we've not seen anything like that extreme reading on that particular price to earnings multiple since, again, around the peak in 2000, when I thought that was as crazy as I was ever going to see. But of course, turns out we've bookended it now 22 years later with the same kind of manic insanity. And it all goes back to the same culprit, which is the central banks, the faith in central banks, the central banks trying to continually bail out bad financial decisions and give funds and liquidity to these reckless players who are ultimately continually blowing themselves up. And instead of letting them go bankrupt or, take their losses, central banks have been backstopping and fueling cash in, and they're going to continually do that. I'm quite sure of that. So the bond market, for example, is selling off right now. The Treasury market as well has been selling off the past couple of days, which means yields are moving higher. The problem is, in this extraordinarily indebted scenario at every level of the economy, as soon as rates move higher, you see things like, pending home sales drop, and you see things like, people pulling back on spending. We've got horrendous auto sales numbers right now, really contracting hard in the past several months, and people's plans to buy big ticket items contracting hard in the past few months. So really you've got this downturn in demand. As I've described before, it's a couple of reasons. One is because we spent so much in the past couple of years on this, support from government and excess money that was lying around, and we bought all these goods the last several years, so you just don't need to buy more of that for the next few years. That's just the very nature of durable goods. And the other thing is that now that not only is there, what we call pent down demand, because people have already filled up their house and everything they can think of in terms of goods, but now you have this debt overhang as well, right? So, and you get into less income support from the government, but also a stumbling job market because you get more lockdowns and problems. And we've had record profit margins for corporations in this environment because they really got a whole bunch of free money and gifts and help from governments, and then they also saw, prices leap and demand for goods seem to be completely inelastic. They could charge a whole bunch of things and people would, whatever the rate people wanted the thing. Well, that's no longer the case, right? So we're seeing that demand is turning down and that companies are sitting with much higher inventory than they had in the last year. And all of a sudden, they're going to have to start eating. If their costs are up, they can't pass that on to consumers. There's just not enough robust demand to do that, and it starts compressing earnings. So that's another factor here. People use these earnings forecasts and they take the record high extreme margins that companies have enjoyed in the past couple of years, and they extrapolate that further. So they say, well, we're going to have that plus another hike to earnings in the next year, and we're going to take that times price and figure out what we should pay for these shares. But in fact, they're already paying this ridiculous amount as the E is shrinking. So we've just set up on every possible front. And back to why I think, bond yields have been moving higher, which means rates are higher, and people are pricing in this expectation that central banks will continue to hike through 2022. I have much less confidence in that, because I think we've seen before, for example, Jerome Powell, the central bank head from the U.S., they call him the Powell pivot now, because as soon as the stock market gets into any stress, he blinks and doesn't want to continue with raising rates, even though they should do that to squish out the excess and mania out of the system. But they don't want to see any decline in asset markets. And so, although the bonds have sold off recently on this pricing in of these rate hikes in 2022, I'd be very surprised if we actually get into the amount of rate hikes that are currently priced in. And if that's correct, because the economy's slowing, because demand slumps, because the stock market's falling out of bed, you probably see central banks, change course again very quickly into the new year. I mean, if we have a bad January in the stock market, I expect by their March meeting they won't be nearly as aggressive as they're intimating in December. And then you're going to probably have, Treasury prices rise in value again. Again, reflective of this slowing economic environment where monetary and fiscal supports have come out. So they're really set up for a lot of hardship on an economic front, but also particularly on asset markets, and not just housing, which is another whole bubble that's been billowing in the past couple of years, but these security markets. So altogether, I think it's really a perfect storm of loss on the risk side. A lot of the speculative gambling people have already been clubbed, basically, but I think that we're going to see a lot more pain go into the mainstream, because the things that they've been doing have also been very risk exposed and passing as sort of normal in this crazy, crazy environment.
On the positive side here, it seems people are falling in love with the Ford electric pickup truck.
Yeah, the Ford's finally getting the memo, right? They keep doubling their plans for production, because every time, when they first came out with it, they sort of announced that they were going to make this very popular truck into an electric version, and they quickly sold out of any orders they were offering, and so they keep increasing that. And now, all the major car companies, pretty much, except Toyota, which is still mind-bogglingly behind the ball, which is crazy when you think about it, because Toyota had, the Prius and the hybrids early on, and like 12, 13 years ago, they were the market leader for that kind of product, and then they've just doubled down on hybrids and refusing to go into electric vehicles. But the other major car manufacturers are finally all sort of getting it and committing to turn their fleets over to full electric over the next 5 to 7 years. Tesla still is the one catalyst for all this, because they embarrassed all the major car companies so much by doing the impossible, by bringing out these phenomenal fully electric cars. And so the other, manufacturers were really kicking and screaming into the future following after them, and now they've sort of they're capitulating and realizing that is where the demand is. As I said, the ICE demand has rolled over so heavily from sort of 17 million units annualized in sort of into 2020, and then back below 12 million again now, and falling sequentially every month in terms of people buying new vehicles. And I think a lot of people are just figuring out, with the spike in oil prices, with the rationing that's happening in different parts of the world because of extreme weather, like you guys on the West Coast, they're realizing that, hey, it's quite vulnerable to need this gas, and gee, it's really expensive. And, full disclosure, I've been driving electric cars now for the last 4 years, and once you have one, you will never go back. It is just such a superior product in every way. And the new battery life, the Model 3 that I have is from 2018, and its battery will give you 450,000 kilometers on a single charge, which is more than enough most of the time for anywhere that I want to drive. But these new vehicles that are coming out now, and the new battery tech, is sort of 750 kilometers per charge. So now we're talking about, the equivalent of a tank of gas, essentially. So this is the total game changer, right? Once a vehicle can go on a single charge as long as a person can on a full tank of gas, there's absolutely zero case to be made for sticking with the ICE vehicle. And not only that, as I've talked about so many times, it's just so much cheaper to run. And a lot of places are figuring out that if you're going to offer incentives, far better to offer incentives to people to buy electric vehicles than to subsidize the oil and gas industry to the trillions of dollars we've been doing when it's such a self-destructive loop. And so it's good. I mean, they keep bringing out, even Daimler brought out a new concept car that they say can go 621 miles of range. They're embedding solar tech on the roof. Like, they're trying all sorts of things. And it's not just the engine or the battery that they're being very innovative with. We're also looking at different materials for the interiors of cars, vehicles, recycled, plant-based instead of many of the traditional forms of interior. And so all of this is a very exciting new chapter, and I think it's one of the strong growth areas. The alternative energy, the electric vehicle energy, the electric vehicles, not just cars, but, figuring out solutions for long-haul trucking, for shipping, for airplanes. These are really the growth areas of the next decade.
Mm-hmm. Well, in Vancouver, Harbour Air is experimenting with electric airplanes.
Yes.
They do short hops. I don't think they fly more than 90 miles or 160 or 170 Ks in any one direction. But for their purposes, electric is just fine.
For lots of purposes, electric is exactly the right thing. And then for, tankers and long-haul flights over the ocean and all sorts of, they are really going to need some kind of a intermediary before the tech gets sufficient to make that kind of power. But, that's where the hydrogen solutions, hydrogen fuel cells, have already been proven to be a good transition that we can use in the meantime for there. So, I still get a ton of mail whenever I talk about this of people that insist this is never going to work and it's crazy. And it's just laughable because I've already been driving these vehicles for the past 4 years, as I said, and I know so many people who have made the switch, and not a single one of them would ever consider going back. So it's really just the people who haven't done it that are so skeptical and afraid, and it's the others that are just seeing the light all the way.
Do you have a problem with pedestrians stepping in front of your electric car because they don't hear it coming?
No.
Okay.
No, I've never had
Because that's the problem I had when I was driving electric. People are so used to listening for traffic, they don't look both ways. And you
have to watch for pedestrians in general today, because many of them are distracted
on
or
their phone
while they're walking. So yes, you have to be diligent overall, but I don't think it's any worse than any other vehicle.
Mm-hmm. Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Check out her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com and we'll ask that question for you. Our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.